Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. We left off last week when I was in the middle of a discussion on really the Trump tax proposals, federal estate taxes, income taxes, inheritance taxes. Boy, we're talking about everything. Gifting limits. Because we're near the end of the year, I have so much to cover. And where we left off last week was when we get to a situation of how much are we allowed to gift every year? And I get asked that question all the time. So, of course, I got into some details that I'm going to continue with now. It matters because the rule is actually you're allowed to, well, there's no rule on how much you're allowed to gift every year. I don't know whether you know that or not, but there isn't. There's no rule on how much you're allowed to gift every year. You're allowed to gift whatever you want to whoever you want every year, and that's always been the case. Nobody believes that, but it's true. The rule is that if you gift more than $14,000 in any one year in up to 2017, you're required to file a gift tax return. Now that's what people are referring to. And that's expected to go to $15,000 in 2018. Annual gifting limit. So that's what that means, and I'll get back to that. So then we got into last week, well, what does that mean filing a gift tax return? So what does that matter? Do I care? And I got the question, I don't want to file a gift tax return, right? So that's when I got into the discussion of, well, I don't know, how much are you worth? We get into the whole area of how much a person's worth. And my example last week I'll continue on is, married couple says we're worth about $4.5 million. And it got to the point where I asked them, well, basically, do you have cars you didn't tell me about? No, that's everything. How about investment accounts, IRAs? No, it's everything we have. And then I say, well, what about long-term care insurance or something? Oh, yeah, but what's that matter? How about burial accounts or whatever? No, we gave you everything. You have any life insurance policies? Yeah, she gets $2 million when I die, life insurance. And I say, aha, your estate's worth $6.5 million, not $4.5 million, unless it's strategically placed in an irrevocable life insurance trust, which it may or may not be. So let's say they messed up and it's not, and now it's subject to the, to be a part of their estate. Now it's a $6.5 million estate. And where I left off last week was, today's laws, 2017 tax code, says the federal estate tax unified credit, in other words, credit toward an amount of money you're allowed to have before you are subject to having to pay a federal estate tax, is an estate worth $5.49 million. Everybody under that is exempt from paying federal estate tax. So you wipe your brow, whew, we got off that one. And that's fine. Now next year, if this proposed tax plan goes in, that limit's supposed to go up to $11.6 million per person. And then after about 5 years, maybe go away and there be no more federal estate tax. And yeah, I know we talk about favoring the rich and the corporations and all, but that is a provision that's in the code. So my high net worth investors have to be aware of this. Now that does not mean we do our estate planning based on that, because 10 years from now we may have new administrations in that go the reverse direction and say, no, we're reinstating the $1 million federal estate tax limit. With a stroke of a pen, we're back. So we don't just casually dismiss federal estate taxes because a current law exempts it. But anyway, the annual gifting strategy is what I'm after here. So we look at this and we say, okay, we don't have a federal estate tax. We actually have a combined federal estate and gift tax code right now. That's probably going to split. It looks like it's going to split off, and they may retain the gift tax even though we may have the estate tax repealed. So gift tax liability may still come into play here. Let's say that it does, and let's go back to, okay, I'm only allowed to give up to $14,000 a year, right? Because that's where we were going with this. Year end, when we deal with this type of strategy, and I've said this year end almost every year, you're allowed to gift without having to file a gift tax return, which means it's totally under the radar. Up to $14,000 from any one person to any other person. You're a married couple. You have 4 kids. Each are married, and each has 2 kids. Now, how much are you allowed to give? Dad can give son number 1, how much? $14,000. Daughter number 2, $14,000. Son number 3, $14,000. Daughter number 4, $14,000. So you say each one of them can get $14,000, right? Yes. Wait a minute, I got mom over here. She's another individual. Is she allowed to give $14,000? Absolutely. So she gives to each one of those 4 kids. Now we're up to $28,000. But you say each of those are married. We like their spouses. Can dad give $14,000 to daughter-in-laws and son-in-laws? Absolutely. How about mom? Absolutely. There's another $28,000 combined. That's $56,000 to each family unit down there. And then each one of them has 2 kids. Can they gift to the kids? Well, not if they're a 1-year-old, you might say, because they're not age of majority. That's not true. Yes, they can. So there's another $28,000 times 2 kids. So we're up to about $120,000, almost $130,000. With a $14,000 annual contribution, annual gifting limit, right? And what month is this? November, December, October, doesn't matter where you are near the end of the year. Can't they say, well, they need more than that now, we're going to have to pay, we're going to have to give it to them. They have medical bills or college bills or, who knows what that came due now and has to be paid now. You say, okay, what about doing all that now? And then January 2nd, because it's another tax year next year, and we're allowed to do $15,000 per person then, do it all over again in January. So now within a 30-day span or 45-day span, we've combined 2 years worth of contributions into a span of about 45 days. We've just shifted $300,000 or $400,000 out of our estate to our kids, totally gift tax-free, totally income tax-free if it was our own money already. There's no income tax specifically on gifts. There's no gift tax staying under the $14,000, next year $15,000 radar limit there, annual gifting exclusion. And bingo, right? We've given a lot. And we still had that limit. So we can be very creative with what we're trying to do. We could fund college accounts. We could do 529 plans. We could do all kinds of things with this gifting. We could pay kids life insurance policies. We could do whatever we want. And we also can not be adversely hurt on taxes to do it. Now, the reason I say that income thing is we're going to talk about this next. If I say you can gift all that money and there's no income tax, but for you to get that money, you have to get it out of mutual funds or sell stocks or bonds. There really is an income tax, not for making the gift, but for where you got the money to make the gift, you might have had to pay tax. So let's talk about that. If you're looking to reduce, there are many reasons people gift. Usually it's to other family members or non-family members. And that rule, what I just said, is family members alike and non-family members alike. So we gift money, usually just to be nice. but we sold stocks, bonds, mutual funds, whatever it is, and paid an income tax. Let's say they needed $15,000 to buy a car. You call the broker and they say, okay, we'll liquidate. And you say, I need $15,000 after taxes, because that's how much they need to receive. So you're selling $18,000 worth of securities to get 15. You did pay a tax to make that gift. You just don't see it. So we look at why we're making the gifts and where are the best resources from which to get that money. If the reason why we're making the gift is to start shifting assets to the kids, that's a whole nother story versus, hey, they have medical bills they need paid. Here's why. If we're starting to shift assets, it's normally for a reason, either a good reason or a bad reason, a smart reason or a dumb reason, but it's usually for a reason. Sometimes the reason is, I'm old enough and starting to, mentally slip. If something happens to me, I don't want the nursing home to get it. I'm going to start shifting assets to the kids. Or I don't want them having to pay inheritance tax. I'm going to start shifting money to the kids. Or I don't want it in my estate. I don't want, probate issues, or I don't want other heirs being able to get it. I'm on a second marriage. I don't want people fighting. I have a estranged son or daughter. They could come back and make a claim. I'm going to start shifting it now. For all those estate planning issues or asset preservation issues, now we have a bigger question. Number one, are they highly appreciated assets? I mean, when Granddad has assets that might be $3 million and the cost basis or amount that was actually his own money over all those years contributed was only $800,000 and it's worth $3 million, we have to think, do we want Grandpa cashing all those in over the next 5 years and strategically gifting the net proceeds and paying taxes along the way? Well, maybe, but maybe not. What about this? What if Grandpa gifts the shares? Why do we always have to liquidate and gift the money? Why can't they just gift the shares? Oh, I didn't know you could do that. So you say, what about if they retitle these shares? It's a gift. The cost basis, whatever Grandpa's cost basis was, comes over to us as the recipient, but the gift is made. It's a tax-free gift still. Now, it's really a future taxable gift because I can't liquidate it if I'm the heir, if I'm getting those proceeds. I can't liquidate it expecting that I'm not going to pay the taxes Grandpa would have paid because I am. So he gifted me his problem. Those shares that would have been taxed to him are now going to be taxed to me when I sell, but not before, let's say. So now we have a case where I would step in and say, all right, wait a minute. And I've talked about this on other shows. You'll find this familiar. What about step up in basis? Here's the thing. Some people say, I want to move these assets because I don't want them having to pay inheritance tax. We'll say, what's your fear about inheritance tax? They'll say, I have a $4.5 million estate, like I just said. Inheritance tax is 4.5% to direct lineal descendants. That might be $180,000 lost. So I don't want to waste $180,000. I don't want my kids having to pay inheritance tax. Plus probate. All the probate fees might be another 4%. So there's another $180,000 or $200,000. And the attorney's fees on top of that. So we may lose, what, $500,000 on that estate? So they'll say, I want to start shrinking my estate down. I want to start shifting assets now. I want to get into 529 plans, and I want to do all these different things to shift assets. Well, the issue is we have to be a little bit careful because while they're correct, a lifetime transfer of assets going into an heir, let's say it's the kids, does avoid inheritance tax then because those assets are now already the kids. we have a lot of risks, but not the least of which is when the kids go to sell those assets, they have to pay all those capital gains taxes on the same gain that the grandpa would have. But had grandpa kept them and everything worked out okay and a nursing home didn't get the assets, we don't have federal estate tax concerns. We only had income tax concerns. Guess what? Yes, the heirs, if they're lineal descendants, the kids pay 4.5% inheritance tax because we kept the assets with grandpa or grandpa and grandma. But all the capital gains tax, remember, grandpa spent $800,000, invested $800,000 into a $3 million portfolio. The rest is capital gains. That's $2.2 million at capital gains tax rate. At that rate is probably 20%. So there's $400,000 on capital gains at the 15% rate. And that may be a higher percent rate on capital gains, depending on an income tax bracket and depending on Trump's tax proposals going through, whether they stay the same or whether they raise those rates. But when you inherit, and the kids inherit, they have a step up in basis. And what that means is they don't pay any income tax. It's eliminated, it's waived by the IRS. They inherit all the assets, capital gains tax free. They could sell all the assets, all the capital assets, the mom and dad's house, rental properties, business for the capital gains, all the investment assets that grew, and pay no capital gains taxes, no income taxes, no federal income taxes on those. Now, if they're earning interest, there may still be some income taxes due on the current interest earned, which is income in respects to the decedent and things like that. We won't get into that. But that just saved $400,000 or $500,000 at least. So, do we want to pay probate? Well, they might do a revocable living trust to consider avoiding the probate. And now we're down to only the $180,000 or so of Pennsylvania inheritance tax. And $180,000 may be better than $400,000 or $500,000. So, some people will say we might do a revocable living trust. We might hold the assets in grandpa's name, inherit the assets, do the step up in basis, and a $4 or $5 million estate only cost us Pennsylvania inheritance tax of maybe $200,000. And the rest came directly to us, they might say. So there are many strategies here. We're going to lose some of this possibly in the new Trump proposal. So we have to be careful. We think we're going to keep step up in basis. We don't know whether Pennsylvania is going to limit property tax write-offs and things like that. I've seen some things lately that have changed on that. But we have heard of states where if the federal government eliminates estate tax, we've heard some states say they're going to implement an estate tax. Our Pennsylvania inheritance tax is somewhat of an estate tax, but they may raise the cost of it, who knows? So these are some tax planning opportunities near year end we need to be aware of. Yes, we could transfer assets to the next generation and gift, but do we want to? A lot of people talk to me about, am I allowed to gift $14,000 a year? I want to do that, $28,000, max it out. And I'll look at their assets and say, wait a minute, you don't have long-term care insurance. You can't medically qualify for it. You actually can't even afford long-term care insurance. Why are you starting to give assets away? You may need those to pay for your care in a nursing home. And don't trust that if you gift it to the kids, it'll be there if you need it back. So be careful here, I'll tell them. It's not taxes that should be driving these decisions. It's personal needs and then strategies with taxes as only one factor in making a good overall decision, not taxes driving as the lead in making all decisions. So a lot of people who are considering gifting, in my opinion, should not be considering gifting if their own assets aren't substantial enough to sustain them if they go into a nursing home that costs $10,000 to $12,000 a month, plus more. which is $150,000 a year, times 4 years is $600,000. Who's got that kind of money sitting around unallocated? Many of the wealthy do, many of the non-wealthy don't, and yet they're still considering making these annual gifts. So I do want to caution everyone on that. Now, if you're making gifts anyway, like to these charities, then we want to be strategic. And we want to say, maybe I want to gift capital assets, gift the shares of my stock to the charity, instead of cashing in the stock and giving the cash, right? Because the charity, as you remember, gets to cash in those stocks and pay no tax. It's tax-free. Or I may take my RMDs from my IRAs and fund that life insurance policy. Instead of giving the charity the RMDs every year, $5,000 a year RMDs, I say, you know what, I bought a life insurance policy for $250,000 or $300,000 for the charity. So they don't get it till I die, but when I die, they get it tax-free, and it's way more than the amount of the premiums, which were the RMDs. So it can do a lot more for the charity. Put a whole wing on a church, or do whatever as an overall goal, rather than these drips of money year by year that really aren't big enough to accomplish a large monumental goal, but they're very, very beneficial to charities nonetheless. So we do all that kind of planning near year end. That's what we do. That's what we're thinking about. Now, we do see the college planning. It's almost FAFSA time. So we get into the year end and we start looking at what's our tax return going to look like for the college planning purpose. Because we say, wait a minute, should I take a whole bunch of income this year because of the Trump tax proposal, where I might have more write-offs this year than next year? Or will that hurt my FAFSA for my college financial aid? Because next year, 2018, they're going to ask for 2017's tax return. They're actually technically looking at 2016's. So 2019, they'll be looking at 2017's return. And if you took a whole bunch of income, it could disqualify you for financial aid where you might have otherwise qualified. And that may be a bigger benefit to you than the tax savings that you were trying to implement in the end of this tax year because of anticipation of losing itemized deductions next year. Do you see how complicated this gets? You have to look at everything in here. But when we're at year end, you need to look at what is this year's tax return most likely going to look like? What is last year's looking like? And I need you to all get out to FAFSA. That's FAFSA. I want you to do your web searches. I want you to Google that. I want you to get out there, and I believe that's FAFSA.gov, by the way, G-O-V, and get on there and do a preliminary FAFSA application to see what it might look like for you for financial aid. I do caution you, as everybody I talk to about financial aid, when they're talking about loans, when you hear the word loans, that is, in my opinion, not financial aid. That is financial funding. When I hear grants that do not need repaid based on my income, that they are saying you're entitled to $5,000 toward your child's or student's education that you don't have to pay back, that's financial aid helping me pay for their college. But when they say either the student's entitled to loans they don't have to pay back until they get a job, or I as a parent am eligible for a loan without otherwise qualifying for it, that to me is not financial aid. That to me is financial financing, financial loans, financial lending. I don't see it as that much different as me going to the bank and saying I need a loan. So it being camouflaged under financial aid wrapper is, well, let's say being misunderstood and taken advantage of too often, where if we realized through its wrapper, wait a minute, that's like me taking out a home equity loan. I don't want to do that. Well, be careful with that when they coined that under the financial aid, because in my opinion, technically it's not. Now, there are a couple other programs I want you to remember about. I said the 529 plan, but I didn't get into it in much detail. Anybody can contribute to a 529 plan, which is a tax-free college savings account. And typically they can be very beneficial. You don't have to have a 529 plan that's directly a state 529 plan. So what you want to do is study what 529 plans work in every state, no matter what school we go to, as long as they accept 529 plans. Then if we pull that money out, it was tax deferred all along the way as far as the gains, and tax free for all of those gains when we pull it out if it's used for college. So that's basically how a 529 plan is. They are portable. So if you assign one child and then it turns out they don't go to a higher education, but your next child up does, you could transfer those assets for that child and still take advantage of the tax-free withdrawal to pay for the college expenses. So that's one good one. And another one is HSA, Health Savings Account. Why a health savings account, and why talk about them now? Why even talk about them in this discussion? It's kind of a concealed IRA type plan. A health savings account is an amount that you're setting aside. And in fact, if they're used for health expenses, qualifying health expenses, years later, it doesn't have to be by the end of the year or next year, like they used to be, it's tax-free and so are all the gains. You can even contribute to a health savings account through work, and after you retire, it still stays with you and the account balance is eligible for tax-free withdrawals even after you're in the retirement years to help you meet medical expenses and be income tax-free. So that's why I say it's almost like a concealed additional IRA plan, but only used for health reasons, another tax-free account. You'll want to take advantage of that, and they are talking about reducing some of the benefits on that in the new Trump tax proposal. So stay tuned. I'll keep you abreast on that. And we're about out of time for today, but I hope that helps for some of this year-end strategy planning. Give our office a call. We'll get together, help you go through, make sure we're addressing a lot of the issues for you that maybe aren't being addressed from the other advisors you're using now. And I appreciate you tuning in. I'll be back again for another week of All Things Financial.